The tips on how to manage your money that Warren Buffett and Elon Musk agree on. It cannot be said that Warren Buffett and Elon Musk are two identical people. Surely the only thing that unites them is the success they have achieved in their businesses, but apart from that, they both have very different profiles. Just look at Buffett's sobriety in the face of the constant attention span Musk seems to continually demand. But, if the two of them agree on some kind of investment or business advice, it may be worth listening to them. These are the investment tips that both billionaires recommend following. Invest only in what you know. The decision with which Buffett has remained firm in investing only in businesses that he understands is well known. In his 2013 letter to Berkshire Hathaway shareholders, Buffett wrote that it is vital that we recognize the perimeter of our circle of competition and stay well within it. Knowing the business well is not enough, however. Although he is known as a long-term investor, Buffett believes that belief in a company is just as important as its valuation. As he stated in his 1989 letter to Berkshire shareholders, it is much better to buy a wonderful company at a fair price than a fair company at a wonderful price. Musk is in the same vein. He is known more for his entrepreneurial spirit than for his investments. Tesla's CEO tweeted in May 2022 recommending buying stocks in various companies that make products and services you believe in. Always focus on the long term. Buffett comes to mind when it comes to holding investments for the long term. The Oracle of Omaha even wrote in its 1998 letter to Berkshire shareholders, "Our favorite investment period is forever." Buffett hasn't always held the shares he's bought for the Berkshire portfolio for long periods. At times he has seemed to deviate from his own advice. But it's important to understand the context of that famous quote about holding stocks forever. Buffett preceded the statement with one condition: the forever holding period is only for outstanding businesses with outstanding management. When Buffett stops believing that a company or its executive team is outstanding, he will sell. Musk shares this philosophy in a way as well. In his aforementioned tweet from the beginning of the year about buying the shares of companies you believe in, he also stated that, "Only sell if you think their products and services tend to get worse." Look at the market, but only they say that when the stock market crashed in 2008, Buffett wasn't worried. He wrote in a New York Times op-ed that, "One simple rule dictates my shopping: be fearful when others are greedy, and be greedy when others are fearful." This perspective is understandable for a man who was mentored by Benjamin Graham, the father of value investing. Graham included a now famous allegory about an investor he called Mr. Market in his classic 1949 book, The Intelligent Investor. Although Mr. Mercado, representing the broader stock market, was usually rational, he sometimes behaved erratically. Mr. Mercado's wild swings presented great opportunities for other investors. Musk seems to fully agree with Buffett on this principle. 7 months ago he tweeted, "Don't panic when the market does." The S&P 500 was 14% below its previous high when it made the statement.